Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So in today's video, we're going to be looking at two books. So firstly, we have The Little Book That Still Beats the Market by Joel Greenblatt, which contains his very famous magic formula. And we have The Acquirer's Multiple by Tobias Carlisle, which takes a slightly different perspective on quantitative value investing and actually has better returns than the magic formula in this book. So these are both quantitative value investing books. In other words, they have a formulaic approach to value investing. They don't necessarily spend time digging into individual companies and doing sort of fundamental analysis like a Warren Buffett or a Monish Pabrai might do. Rather, they have sort of a screen or a formulaic approach that puts together a basket of stocks that meet a certain criteria, invest in those stocks, and over time both of these strategies have beaten the market. I want to get into my thoughts on both of these and run you through sort of the strategy that each of these approaches takes and just give you my thoughts on the whole thing. So I hope you enjoy. I definitely highly recommend both of these books. I actually read The Acquirer's Multiple before I read The Little Book That Still Beats the Market. If I was to do that again, I would do it the other way around. So I'd probably read Joel Greenblatt's book first and then The Acquirer's Multiple. The reason for that is The Acquirer's Multiple actually compares itself against Joel Greenblatt's magic formula quite a bit in this book. So if you are looking at reading either of these books, I would go for Joel Greenblatt first, then The Acquirer's Multiple. They're both really good, easy reads, relatively short. I think they're both around 150 pages. So with all that said, let's get straight into the details of what each of these strategies entails, and let me give you my thoughts. Now, firstly, let's talk about The Little Book That Still Beats the Market by Joel Greenblatt. Now, if you don't know who Joel Greenblatt is, he has written actually several books on value investing at this point. He is a professor on the subject, and he has had a phenomenal track record. So in the earlier part of his career, he was much more focused on special situations, mergers, spin-offs, bankruptcy investing, all these sorts of things that created special opportunities for the market to misprice certain securities, and he ended up with a phenomenal track record of something like 50% per year returns annualized, which is just probably the highest performance record I've ever heard of, even if it was over a reasonably short period of time, not multi-decade like we see with Buffett. And then he sort of transitioned to more of a quantitative approach, which is exactly what he talks about in this book. And it's a way that he sees that the average investor can design their portfolio in a way that can beat the market and generate really good returns over the long term. The book also happens to contain plenty of dad jokes, which I am, although I'm not a dad, I'm a huge fan of a dad joke. So if you're into that sort of stuff, it's in here as well. Now, let's get into talking about the magic formula. So the magic formula basically has two components, and it ranks stocks essentially on two different metrics. So the first one is earnings yield, and I will put the formula for that up on the screen here. And interestingly enough, the earnings yield formula is fairly similar to what Tobias Carlisle's Acquirer's Multiple actually looks at as well. But that's the first criteria, is an earnings yield. The second criteria is a return on capital. Now, basically what each of these metrics is intended to do. Firstly, the earnings yield simply looks at how cheap a business is based on last year's earnings. So if last year the earnings were $10 and you can buy the shares for $100, that's an earnings yield of 0.1 or 10%. So it's basically ranking all the stocks in the universe that this formula looks at on what has the highest earnings yield. The other thing it looks at with return on capital is basically a metric or a proxy for business quality. Now, we hear all the time people like Warren Buffett and people that follow Warren Buffett talk about things like wanting to have a business with a high return on equity, a high return on tangible assets, a high return on capital, all those sorts of things. And this is a way that Joel Greenblatt is doing that same sort of thing and really looking for high quality businesses that are likely to have the opportunity to reinvest their profits at high rates and continue to compound the equity of shareholders over time. So those are the two things that the formula looks at. Essentially, it ranks stocks from 1 to however many stocks are in the list on both of those metrics, and it combines their score on each. So for example, if a company had the best earnings yield in the entire screen, then it would have rank 1, and let's say it had the 19th best return on capital in the screen, it would have a score of 19 from that. You combine the scores, you get 20, and basically you're trying to invest a little bit like golf in the companies that have the lowest score, so that they rank ideally highly on both earnings yield and return on capital. And over time that has created really good results, and Joel Greenblatt's reasoning for that is basically you're buying above average businesses in terms of business quality with the return on capital metric in there, and you're buying them at below average prices, and that's basically what many value investors are trying to do, and it has performed very well. So I'll put up some screenshots here or some images out of the book just to show you some of the returns that this particular formula has generated, and that's what Joel Greenblatt is talking all about. Alright, so let's talk about the acquirer's multiple. Now, Tobias Carlisle, the author of this book, puts out some great content on YouTube and also on his podcast, the Acquirer's Podcast, so I definitely recommend checking that out. I am certainly a regular listener to all of those. So, Toby was born in Australia. He actually started out as a lawyer, and his first kind of introduction to investing was both through his law practice and also through seeing Australian investors actually invest in these broken, sort of failed businesses that came out of the dot-com boom and subsequent bust. And he saw these investors buying these businesses that were not making any money, that had basically no business, but they were still going in and acquiring large stakes in these companies. And he was sort of sitting there trying to figure out why. And looking back at it now, it's obvious that, you know, these investors were activists that were going in a very Ben Graham style and basically winding up the companies and taking the cash out of that business. They didn't really care about the underlying business quality. They were taking out the cash that was sitting there because they could buy shares in that company for less than the cash per share that they had. So that is sort of where Toby got his start. He had some very successful sort of net style investments through the financial crisis, actually, that returned hundreds of % over the next few years, and he went on to write the Acquirer's Multiple after that. So basically what this book does is it takes us through some slight variations on the magic formula that Joel Greenblatt talked about. So one of the interesting things that Toby went back and did is he back tested the magic formula and found that it worked, just as Joel Greenblatt found. He found that it didn't work quite as well as Joel Greenblatt had described in his book, the little book that beats the market, but nonetheless it still performed very, very well and it beat the market. One of the interesting things that Toby found actually though was that if you actually completely eliminate one of the components of the magic formula, if you eliminate the business quality component and you just focused on the very beaten up cheap stocks regardless of what the return on capital is, you actually had better long-term returns than the magic formula. Now, the name The Acquirer's Multiple originally actually comes from a book that Toby read, and it's essentially a metric that activist investors, again, would tend to look at when they are focusing on potentially acquiring a business and seeing how cheap it is. And that formula is EV to EBITDA, or enterprise value to earnings before interest, tax, depreciation, and amortization. And that basically means he's looking at how much money the business produces versus the enterprise value of that company. And Toby is the first one that really explained in a crystal clear way through this book why we should focus on enterprise value. And that's actually a key change that I've made in my own investing, is sort of evolving from this market cap focus, or I guess originally starting out everything's on a per share basis, then you look at a whole company basis and you're looking at the price through market cap, and then you start to be a little bit more intelligent and incorporate debt and cash and then focus on enterprise value. So I thank Toby for that. He was definitely the first person to explain that really clearly to me, and you'll often hear me talk about enterprise value on the channel, and that is one of the core reasons why. So the key question that Toby goes through answering in this book is, why on earth does forgetting business quality and just focusing on this cheap acquirer's multiple metric turn into better returns? And it really comes down to one core idea, which is something called mean reversion. Now, mean reversion is basically the idea that over time, businesses and the prices that people pay for businesses revert to the mean. So you can go through these periods of time where companies have really high return on equity, really high return on invested capital, or really low return on equity and really low return on invested capital. And what happens is if you plot those metrics for those companies over time, the businesses that have those really high returns on capital tend to go back to a normal, more average return on capital over time. And the businesses that were performing very poorly actually tend to improve and move more up towards the average over time. And this is really a reason why buying, in Toby's opinion, those really discounted businesses can actually produce excess returns, as you're often buying these really beat up companies. Firstly, they're extremely cheap. With the focus on enterprise value, you're buying companies that have a lot of cash and not a huge amount of debt, so they are well financed and they're in a position to, I guess, get things back on track. And over time, this mean reversion and buying really discounted businesses has produced, frankly, spectacular returns. Now, depending on which sort of market cap size and which universe of stocks you focus on, whether that's only stocks below $100 million, for example, or stocks only above $1 billion, whichever sort of way you slice up the market, regardless of how you do it, the acquirer's multiple approach has performed really, really well. Ballpark, something like 18% per year compounded from the mid-70s through to around 2017. So just incredible returns if you compare that to the market. Again, I'll put up some screenshots or some photos here of tables. You'll see that the outperformance is just ridiculous. And if you understand the maths behind compounding, you'll know that even a 1 or 2% outperformance of the average market over a long period of time can result in as much as a double or a triple in what you end up with at the end, depending on how long you're investing for. So to have a massive outperformance like this can really do spectacular things for your investment returns and for your net worth over time. So that was a brief summary of both the little book that still beats the market and the acquirer's multiple. I highly recommend you go check out both. And I just want to spend a couple of minutes talking through, I guess, how this has or hasn't impacted my own personal investing. Now, both Joel Greenblatt and Toby Carlisle basically say that, you know, we will go through periods of time where either of these formulas just don't work. And it's really the fact that they don't work which keeps them working for a long period of time, which sounds kind of odd, but you know, if you take something like the magic formula, for example, you're buying above average businesses for below average prices, and that fundamentally is pretty much always going to work, in my opinion. So when you go through a period of time where the strategy actually is not as successful as the long-term track record might suggest, you get a lot of people basically bailing out of that strategy. And you're seeing a lot of that at the moment where people are suggesting that value investing doesn't work. You know, Warren Buffett's lost his touch, all these sorts of things. And what that means is you start to get these wider and wider spreads between the really cheap stocks and the really expensive stocks. And again, listening to some of Toby Carlisle's work, we're at about as stretched or as wide a gap as we've almost ever had. And it means that for the people that can really stay the course with these undervalued businesses, you know, type strategy and value investing in general, it means that the payoff is likely to be larger over time, because if everyone knew it worked and it always worked, the opportunity would be arbitraged away. The price would go up to reflect that it always worked, and then it would no longer work. So the fact that it does go through these periods of underperformance and periods of overperformance, frankly, is a good thing if you're someone that wants to follow this type of strategy over the long term, because it means that the opportunity is just about always going to be there. Now, in terms of how this has impacted my personal investing, I guess the first thing I've already mentioned is to have a much larger focus on enterprise value. That's something that I've implemented for at least a few months, if not about a year at this point, is really just having a stronger focus on enterprise value. The second thing is I often actually get asked about how I screen stocks or whether I screen stocks at all. And I pretty much always say that I really don't, because I'm usually looking at stocks from things like 13F filings, just general news that comes out, keeping up with companies already on my watch list. I also run this YouTube channel and work a full-time job and try and train for powerlifting and stuff like that. So I really haven't got a huge amount of time in the day to run screens and research stocks as much as I would like. But frankly, that is something that has changed a little bit since reading these books. So I have started to focus on looking at the acquirer's multiple screen. That is something that you can access for free, I believe, on Toby's website. There might be some restrictions in terms of the market cap range it looks at on the free version, but you can go ahead and look at that. Joel Greenblatt has, I believe it's magicformulainvesting.com, where you can go and look at the Magic Formula stocks completely for free on his site. And basically that just has opened up this whole new universe of individual companies to look at. So one of the things that you can often get with these sorts of basic screens is that you get these odd businesses that maybe had one really good year, or something odd is going on that means they look really cheap on the surface of things, maybe based off last year's earnings, but they're not necessarily that cheap based on what the future earnings are likely to be. So it puts together a screen and sort of a universe of stocks that I can start digging through and see whether they're just outlier stocks or whether they are genuinely cheap. And it's been a great kind of resource for me to help get more things come across my table to keep digging into and continue researching. And you'll probably be surprised at some of the stocks that come up there. You know, Apple even was included in the acquirer's multiple screen as one of the cheapest stocks in the market just 3 or 4 years ago. That's right when Buffett was buying in, and you know, it's basically tripled since that point now. So definitely some resources I will continue to keep an eye on, and they are great reads as well, so I recommend you check those out. And that's basically it for me today. So I do hope you enjoyed the video. If you did, please hit like and hit subscribe. If you've read these books or you have some thoughts on both the Acquirer's Multiple and the Magic Formula by Joel Greenblatt, certainly let me know. I'd be keen to hear your thoughts. But that's all from me today, so I hope you enjoyed the video. Hit like, hit subscribe, and I will see you in the next one. Cheers.